So it's interesting, you guys are all focused on commercial drivers and commercial diligence. I mean, to what extent have you, as investors, found yourselves in a position where you want to walk away from something for legal diligence reasons? I'm interested in this because a lot of people complain about, or I have heard complaint in sort of early stage investing, that there's too much focus on diligence. And I think that is now very much disappearing because the influx of big international investors and capital, we are seeing very, very rigorous due diligence across legal, commercial, technical, the whole thing. So I think that there's a standard that's being raised across the market. But I'm interested that none of you guys have talked about, beyond maybe referencing, say, fintech regulation and how easy it is to cross into multiple markets. So, I mean, in terms of your experience, how often have you walked away from a deal because there's a legal issue?
I mean, at late stage more than seed stage, for sure, but not that often. And it's usually if you discover a governance or ethical point that could be a worry. So, for example, something that's happened with us in the distant past was, you'd find that the founder is kind of split off the IP into a separate company and is charging it back to the main company. Right. And this is kind of Series B company, a late stage company. Or where you find the founder has more shares in the company that he's hiding for whatever reason through his, through a different, you find stuff like that you never understand why they're doing it.
Although you find that in K1 filings by WeWork
correct,
as well.
Correct, yeah. So I think that's the stuff that...
I think that's where they learn it from.
I think legal DD is to help, at least at the stages I think everyone around the table invests in, is to help institutionalize a business. So you find things, say like, let's fix this, let's make this so that we drive value in the company. I think the stuff to walk away from are the ethical points, right? Where there's a clear misalignment on kind of values, which is, and that's when you say, and that's only happened, I mean, at least for me in the past decade, like maybe 3 or 4 times only, which is a good sign, right? There's not that many
but
things.
We've walked away plenty of times, and I include cap tables in the legal part. Let's just, I understand the points you're making, but for me, cap tables that are dysfunctional, that have too many shareholders, or have holdings that are, numerically impossible to work through, so someone has ultimate control on decision making. Venture capital is a partnership, right? It's a partnership of multiple investors and the founders going on a journey where you give the benefit of the doubt to the founders in the early stage, right? By giving them a big chunk of the business and putting these businesses, let's just be clear, they're not worth what the first, on a Series A, they're not worth that number. But you're keeping in mind that the company will raise multiple rounds, there will be dilution, and so you have a target percentage holding, that will ultimately result in how the business, reaches its kind of ultimate goal, profitability, exit, IPO, whatever. And so, but you see people very early on make unfortunate mistakes where they give away too much of the cap table because a certain investor is a traditional investor, kind of goes, I need 51%. And then now it's like, hold on a minute, I'm trying to get into a partnership with the founder, not with this other investor. There's simple things like that. But the other part, and I'll say this over again, there are not that many law firms or lawyers in the region who understand the commercial aspects of venture, if you understand what I mean. So can you get a lawyer to do paperwork? Sure, right? Can you get good lawyers who understand venture, understand the dynamics? Not that many, Abdullah, right? There's a handful, Tamimi and a couple others that I can count on, that I can say to you that really understand when they're looking at the documentation, that this isn't just about what's on the paper. It's also about the way the investors approach. And there is a point in negotiations, and we've walked away, where it's clear either the founder or the other investors don't understand what's happening here, right? The level of trust that has to be built to be able to move a VC deal forward.
Yeah.
I think when you add the cap tables to this, then
the list goes big.
Then the number of times you walk away becomes big, because unfortunately it's quite common. These kind of weird, lopsided, dysfunctional, or overly complex cap tables, unfortunately, is more common than we'd like.
On the early stage, usually what you see is bad structuring, bad jurisdictions. Those are kind of things which you see, which are usually troublesome. But when it's early enough, they're probably repairable. And when if good quality money is coming in, that is the time to repair them. so which is possible to do. But obviously the person should be ethical, the founder should understand what's happening, early investors should be ready to take a haircut and say, hey, listen, it makes sense, now it's going a different level. I can't hold 51%, those kind of things. Those things happen. Good companies, those things happen. Good founders are able to kind of circuit around that and stuff is fine. But, there have been cases where, mostly the ethical reason has got me to walk away from a particular deal is because more ethical, because everything else is solvable in my opinion. Even if there's a structuring issue, even if the cap table is lopsided, there's methods of solving that. As long as everybody believes, the journey has begun, like in the sense we are going together on a journey and this journey requires us to, for example, change the seats, or modify, how we're going to go forward. Now, it's a difficult thing when you're working in, for example, jurisdictions where you have issues. So that's the other thing, when you're crossing borders, you suddenly find this myriad of companies that they've formed in different jurisdictions, and they're trying to do a holding company, but they don't really have rights, they don't have this, they have a local partner. All those kind of issues are a minefield which, people like you probably have to advise. And I repeat that point, which Vasu made. You need a lawyer with a commercial hat, a person who understands the deal and why that deal is happening, as much as how to make sure it's kosher by law.
Yeah, I mean, just from a founder's perspective, the challenge is exactly what PK articulated. We talked about the difference between the Middle East and the US. The US, as a single market to a certain extent, state law can then pass federal. There are examples of one state that can then be passed into others. There are certain jurisdictions where you're encouraged to set up. The legalities of that is pretty standardized. Here in the region, the immaturity of the venture capital space, which has come a long way in the last 5 to 10 years, still from a legalistic perspective, commercially, registration, etc., for a first-time founder is a minefield to try and navigate and set up. And therefore, the need for affordable and useful legal counsel to put yourself in the best position for fundraising and to scale as a business is one of the biggest challenges. Now, a lot of terms have been simplified, a lot of but it's even before you get to the point of commercial terms, it's how do you structure yourself as a company to be investable, because otherwise you need to put a huge amount of funds into becoming an investable operating company.
Yeah, I mean, look, it's for people like me, this is fertile territory because, in our region, we obviously have a very large region. The laws are very different in all of the countries here in MENA, but also, if you look into Africa, if you look into Turkey and the broader emerging markets around us, very, very different legal systems. Venture capital, in order for venture capital deals to be done, they have to involve certain structures, certain rights, certain terms that just aren't implementable under most legal regimes across emerging markets. Actually, to be completely blunt about it, it tends to be common law legal systems that permit things like, disenfranchisement rights, like a call option, for example, something that's very simple to implement in the US under any US state law, or in Europe or in the UK, but in the Middle East, almost impossible, in Africa, almost impossible. So you have to kind of create these holding systems and so on. So yeah, I mean, from a legal perspective, definitely a lot of structuring goes into it.
Another point that I would make is most of the funds are structured abroad, a Cayman structure or a structure which is predominantly in US dollars and actually ends up investing. We, I believe, haven't seen, because of the pegging of major currencies in the region, we haven't seen structures which are required to make sure you guard currency risk. Have not happened really here. Like in India, Pakistan, Asia, you've seen that happen. You've seen, countries being wiped out because of currency or the currency risk. How do you make sure that those risks are covered? So I think there'll be a lot of legal kind of layers which will be built over time to do that. Because as you go wider, for example, like most of the people are now thinking, the country I heard today, Turkey and Pakistan are typically areas where everybody is extending to. Both of these countries have currency risk, which you typically didn't see in the Saudi and UAE, kind of a scenario where the dollar was pegged. Doesn't matter, you pay dollars and we can just exchange. It's one-time exchange cost, whatever it is. That's the way people see it. But what they don't see is when you start extending, you suddenly will start seeing far more risk coming in. And now venture capitalists will have to structure that in their structure because they need to return back in their parent currency. Correct? So that is something which will actually make us look for even more, structures in terms of legal coverage to cover those things.
But herein lies the opportunity, right? It's in this friction, in these challenges, which is what the entrepreneurs here in the region are trying to solve for. And hence some of the more successful entrepreneurs and founders, etc., end up being operationally focused because it's these challenges while they grow the technology and they grow the product and the customer demand. Being able to navigate this minefield is what makes them a very attractive acquisition for an international acquirer.
Right.
Whereas in other markets, there may be 10, 15 companies doing exactly the same thing, using the same frameworks. There, the product, the pricing, and etc. is much more of a differentiating factor. Here, being able to navigate all of these challenges is the opportunity that exists.
And that reminds me of a really interesting point that I wanted to cover with all of you guys today. And given the date in which we're filming this, the rise of SPACs in the last few months, it's been pretty dramatic, the volume of those kind of deals that have happened. We've actually seen quite a few of them in our region, even though not all of them have been heavily publicized. We've had at least one regional company that has been acquired by a SPAC. We've had a lot of regional investors who are investing in SPACs and business combinations. We know that there are at least 3 or 4 companies right now in discussion with US listed SPACs. It's a really interesting phenomenon. So I want to kind of come back to the governance point that all of you have touched on in some form.
Yeah.
Because the route to exit for companies in our region has always been fairly restricted, I would say, to the trade sale. And the typical cycle would be, early stage venture, slightly later stage venture, then growth capital would involve either late stage funds or private equity funds, and ultimately the exit would be through a sale to a strategic. Our capital markets haven't seen a huge amount of deal volume, and certainly they're not set up for technology company exits. And in fact, I think there's been only one technology company exit in the region, which is Foley in Egypt.
Yeah.
But obviously the rise of SPACs has now made it faster, easier for regional tech companies to find themselves listed on a stock exchange. Actually, at the moment, it's primarily the NASDAQ in New York. But how ready are these companies? And from a governance perspective, do you see any issues in terms of regional tech companies going down the SPAC route? And are we likely to see any kind of blowback from this?
It's not, on the onset, it's a good thing, right? Enabling access to liquidity for investors and a route to exit. And that's all really positive and really good. And big fan of that, even though they're taking a bit of a beating now, like it was today, like the SPAC. But I think the governance point is, are these companies ready to go public? It's not a local problem. This is a global question, right? Even US companies are kind of shortcutting into kind of being listed through a SPAC. Is that, are these companies, are these teams, are these management teams ready to manage public companies where the margin of error is much smaller? You have to be very careful how you report, etc. That is a worry, and I think the blowback is if it were to come, and I'm sure there's going to be some governance lapses somewhere with some these SPAC companies. Most likely it won't be focused on us necessarily, but it'll be focused more generally, right, on that mechanism of how companies are going public, and are these teams ready to manage a public company? I think that's a huge question. Do they have the infrastructure, the setup, the governance, the reporting standards to be able to kind of comply with what the SEC requires, right? And also have the discipline. If you're not Elon Musk, you can't just say whatever you want, right? Unless you're Elon Musk, right? You can't do that. So I think that's part of kind of the challenge with these companies. But on the whole, it's good to kind of democratize access both for investors and for the investors in public markets to get access to private companies earlier, and the flip side for private company investors and founders to be able to enter kind of equity markets more broadly.
I think it's like history repeating itself. Like we've always learned on a steep learning curve. whatever we see today is a steep learning curve. We actually accelerated, we learned from other people. There are quite a few stops we didn't go to, this ecosystem as an ecosystem. I think that's what's going to happen there. We'll have to learn. This will be a steep learning curve for a lot of founders who are doing great, get used back as an exit route. But they will realize that they have to actually deliver far more, be far more transparent, be far more in the public eye. The things that they can't do or they have to do, those things will actually get forced. A lot of things they may not be used to, like being so transparent, being so open with data, like everything is, forcibly public and all that, which doesn't go with the grain of a lot of people here when they start. So, which I think they'll have to learn. The company which has gone public, the Anagami story, will be a good case in point in that sense. We'll see how it goes. I think they're big enough to reach a point, and they work with a lot of large companies, like the music owners and all are far bigger public companies themselves. So I believe there's a transparency in relationships and things which has happened. So I think it may be easier for them, which is good, so that they set up a good kind of pathway for others to follow. So I think it's a good starting point. I'm not so sure about if this SPAC whale will continue the way, or will it turn out to be as clean and pathway for a lot of people as they think they are. And because initially when something new comes in, a lot of people who are going that route are people who probably know they have no other way of exit, rather than companies which use this as a, one of the ways and they have other options.
No, and I agree with everything said. I don't want to repeat it. No company is ever ready for this. There's lots of ways to get ready. There are lots of advisors and consultants and all sorts of people to get ready. But the part you have to ask yourself, which is the one I think about, is if you have a Middle Eastern company listed on the New York Stock Exchange or NASDAQ or wherever that ultimately they end up, do the investors there understand the business? Can they ask the right questions to appreciate the value of the stock? And does the founder have the capability to communicate the story that will allow this share price to hold its own and grow over time? I still believe, and I've written about this, and I continue to try to speak about it where appropriate. We have to open up the local markets here. Let's just be clear, right? And it kills me that so many different pools of investors are able to access VC now, but the retail market isn't yet, right? I think that's a big shame or opportunity or where we need to go next, because it doesn't make sense that technology is one of the fastest growing industry in the world, and yet we have, as you said, one listed company, right? People, or whatever it is. I mean, maybe there's a couple more that that are half technology companies or whatever the case might be. The reality is the stock markets here need to open up and find ways to list companies, which, yes, by nature may still be unprofitable. They may have a short, lifespan since they birth to kind of when they list. Those are things we need to overcome regulatory-wise and other things. But I think the local investor here will appreciate some of the brands that are being created around them than they would U.S. investors, right? Or European investors for that matter. And I think that's just, to me, the side that I think founders who are looking to go SPAC, and that might be exciting. You're about to talk to a bunch of analysts and investors who will literally ask you, where is Dubai, right, on the map? And they may not even understand that it's an emirate and not a country. And, they'll be confused, which will affect your share price, which then puts pressure on you to have to perform in a, more. I mean, it's not simple
but
to just SPAC.
in an environment where we sit, where people actually are followers, in the sense they follow and put their money, not because being the first people to put money in that category, but how others have made money in that category. It's such a followership here. Maybe these SPACs will actually tell them that it's possible to have publicly listed companies from here, allowing a local market to actually flourish. So I think it's a chicken and the egg, and all of us have this responsibility, in my opinion, to actually ask for more transparency, which is a mainstay for them being able to be, SPACed or taken public in whatever way. So I think that is something which we should actually ask for.
Well, so on the transparency point, I just want to make the point, not about SPACs, but actually what we as Magnet, when we're tracking this investment data, are beginning to see a new, not issue, but something that we need to acknowledge. Before it was just equity. Now you're seeing venture debt, convertibles, SPACs. You're seeing secondaries that are taking place. And unfortunately, they're all being wrapped up into a single number. Whereas actually the reality is that there's different portions of things that are being done. So when we're trying to track the growth and the evolution, you start seeing in other markets, people will track venture debt versus equity versus SPACs versus exits, CVC and etc. That's a positive sign that it's maturing and that there's a much more diverse pool of instruments that can be used. But the understanding of each is something that I think people need to get wised up about as well.
I think the recent announcement of this massive round by company, which turned out to be majority venture debt rather than equity injection, is actually a thing which should be called out, in my opinion. Like, in a sense, be clear, say this is equity and this is this, and don't, as you said, put it in one bundle and make it look like the largest Series A deal ever.
Yeah.
Like, I think that's disingenuous.
So that one's aimed at you, Philip. I think.
The problem is, I don't know, it's aimed at us. I mean, the problem is, journalistically, cool, you can ask, but if they don't want to divulge it, whose responsibility is it? Is it the founders? Is it the investors? Is it the regulators? I mean, we can only do so much, but if people don't want to share that level of data, there's very little that we can do without putting ourselves at risk. So I think it's an open call for greater transparency, because until you get to that level of transparency, you're really not learning on which instruments are working best.
That's why I said it's all our responsibility.
Yeah, absolutely.
That's why I said, like, it's all our responsibility to demand these things. And not be, we can all take the responsibility, not my job, like, in the sense. It's nobody's job. I don't know, the regulators can say the same.
Sure.
Hey, you know what, it's not regulated. You can raise money the way you want it. And, the press gets a press pack from the company which says, hey, we raised the biggest round of this much. It's not press's responsibility to go and talk to every investor and ask, oh, did you put that much money? All that. So, but when we come to know about these things, we should actually raise the point. My opinion is, it's a responsibility. It's our ecosystem at the end of the day. Yeah. Because once they get away with this, the others will be tempted to create these kind of, press releases the next time. Because now, this part of the world loves superlatives. In fact, every part of the world loves superlatives. So the biggest Series A deal, now somebody is working towards making a bigger Series A deal. Already, you can think about it.
Trophies.
Finding a method of how to pad it up and do that.
And we're very dear to this point. Like, we were very clear that we want to differentiate these factors, but we can only get as much as the people are willing to provide us. And that's why I think it's important to differentiate and to start charting them separately, because as founders, you also get skewed by these announcements and think that either you're not performing well or how is it that this company's done better. But it's not apples for apples. It's mixing different things together. So I think that's an important
When you
thing.
start asking questions, like, for example, a magnet analyst who's talking to them starts asking the question, okay, fine, can you define how much is equity? Now, some people may not, but it'll start becoming something which will be difficult to hide after a while.
I think generally on the issue of transparency in kind of our ecosystem as it heats up, I mean, there is a certain lack to kind of challenge what's stated, right? Whether that's like what a round size looks like, etc., or to delve into, failures, which is important because that's how we learn, right? As a whole, right? So there's still that mentality of like, let's not talk about how things have gone sideways because we can learn from that, and let's just forget about it, and there's somehow this kind of like, we all agree not to, like, vow of silence. We all like agree not to talk about anything negative, but out of that we can learn, right? There are kind of good learnings from this stuff, and that's not to be kind of like, negative for the sake of being negative or cynical, but just to, how do we kind of transcend it?
Yeah, it's saving face, right? And the idea that somehow you have to be the biggest Series A or never had a failure. And that, I mean, listen, everybody's had them. I think we all know, I think some of the VCs know, like, for each other's stuff, but I think it's kind of a little bit shame on us for not bringing it out into the public market. I think the problem is how do you bring it out in a learning way where people can benefit as opposed to a criticism. Right? And people are not understanding that this VC is by definition high risk. It is by definition taking bets. You can be you'll be wrong more often than you will be right. But the ones that are right will pay back everything you've done and more, right?